All right, ready to jump into the wild world of crypto trading. We're going to talk about risk management today. The thing that can make or break your success in this crazy market.
Absolutely.
You sent over this super interesting blog post from payset.io
Mm-hmm.
all about navigating risk in crypto. And that's exactly what we're diving into today. So no holding back. Let's get right to it.
Great.
Okay, so first things first, crypto volatility, right? This market is like a roller coaster that never stops.
Yeah.
Prices are constantly changing. It's 24/7. There's no downtime. What's the deal with all this craziness?
Well, you got to remember, crypto is still relatively new, so there's this constant process called price discovery happening.
Price discovery.
Yeah, it's basically like, imagine everyone's trying to figure out what something is worth at the same time, and nobody really knows.
So like when a new gadget comes out and everyone wants it, but the price is all over the place until things settle down?
Exactly. Throw in the fact that crypto trading happens around the clock, globally, and yeah, you got a recipe for some serious price swings.
Makes sense. So we've got this crazy volatile market. What are the major risks we need to wrap our heads around?
Well, there are two main types. You've got systematic risk, which affects the whole crypto ecosystem. It's like a tide that lifts or sinks all the boats. And then there's unsystematic risk.
Unsystematic, yes.
Yeah, that one's specific to individual assets, like one of those boats suddenly springing a leak.
I see. So like if the government steps in with some massive regulation that hits all cryptos, that would be systematic risk. But if one particular exchange gets hacked, that's unsystematic because it only impacts that platform and its users.
Exactly right. And speaking of risks, let's break down a few key ones that the payset.io post highlights. Starting with market risk. They compare it to, well, a roller coaster. You know you're in for some ups and downs, but you never know when those drops are coming or how steep they'll be.
That's a perfect analogy. It's that uncertainty that makes crypto so exciting, but also kind of scary. All right, what about specific risk? They mentioned it's like betting on a horse race, which honestly I've never done, but I get the idea.
Right, so picture this. You've done your research, found a promising altcoin, great team, solid white paper, everyone's talking about it. But even then, things can go wrong. Maybe a competitor pops up or there's a technical glitch. That's specific risk, just part of that particular asset.
So even the best racehorse can trip, huh? No investment is foolproof. Okay, last one from their list, liquidity risk. They compare it to selling a rare collectible.
Imagine you've got this valuable antique, right? It might be worth a fortune, but if there aren't enough buyers, you're going to have a tough time getting the price you want.
Oh, I see.
Same goes for crypto. If you need to sell quickly, but there isn't much trading volume for that asset, you might have to accept a lower price than you'd like.
So before we even get into managing these risks, just understanding them is a big step, wouldn't you say?
Oh, absolutely. Awareness is key, like knowing the trail before you set off on a hike.
Right.
It lets you anticipate obstacles and plan accordingly. And once you're aware of the risks, then you can start to come up with strategies to manage them. That's where things get really interesting.
Okay, I like where this is going. So let's talk about navigating this crypto jungle safely and strategically. And I got to start with the classic advice. Diversification. Don't put all your eggs in one basket, right? Everyone says that.
Right. Diversification is key, a fundamental risk management principle. Instead of going all in on just one cryptocurrency, spread your investments across different assets. Reduces your exposure to any one single risk. It's like building a balanced breakfast.
Oh, I like that.
You wouldn't want to eat only cereal every single day, would you?
No, I need my fruits and veggies. Got to stay healthy, right?
Exactly. So in crypto, that means maybe some Bitcoin, some Ethereum, sprinkle in some stable coins, perhaps a few smaller altcoins that show potential.
Got it. So we're spreading the love a bit. But isn't Bitcoin still like the big gorilla in the room?
It is. That's the thing about diversification. It's helpful, but it's not a magic bullet. Bitcoin still heavily influences the entire market.
So even if I diversify, if Bitcoin takes a major hit, it's going to drag a lot of other cryptos down with it.
To some extent, yeah. So diversification helps cushion the blow, but it's not a complete shield.
Interesting. So what else can we do to really minimize those potential losses? What are some strategies we can put into action?
That's where position sizing comes in. This is all about figuring out how much of your capital you're willing to risk on any single trade. And this is where discipline is super important.
Discipline.
Yeah. Even if you're totally confident about a trade, you should never risk more than you can afford to lose. Like, think about it. You wouldn't bet your whole life savings on a single hand of poker. Right.
Definitely not.
It's all about calculated risks, not reckless gambling.
Makes sense. So if I have, say, $1,000 to invest, I shouldn't be putting all of that into one trade. Should I be splitting it up?
Right. A good starting point is the 2% rule. You risk no more than 2% of your total capital on a single trade. So in your case, with $1,000, that'd be $20 per trade.
$20.
Of course, you can adjust that based on your own risk tolerance and your strategy, but it's a good guideline to prevent overexposure.
Okay, 2% rule. Got it. So diversification, spreading those bets, position sizing, knowing how much to put down. What about analyzing the market itself? Can we get a sense of where things are going, or is it all just a guessing game?
Well, there's something called technical analysis. Some people might think it's like reading tea leaves, but it's actually a way to study past price data and look for patterns and trends that could give us some clues about future price movements.
Well, okay, so it's not about predicting the future exactly. It's more like being a detective looking for clues and patterns.
Exactly. It's about looking at charts, candlestick patterns, things like moving averages, the relative strength index.
Right.
It takes time and practice to get good at it, but it can be a pretty valuable tool, especially when you combine it with other strategies.
Sounds like something I need to learn more about. So let's say I've done my research, diversified my portfolio, I'm using the 2% rule, and I'm even starting to dabble in technical analysis. Is there anything else I can do to protect myself in such a wild market?
Absolutely. That's where stop-loss orders come in. Think of it as a safety net for your trades. It helps to limit those potential losses.
Stop-loss orders. Okay. So help me visualize this.
Imagine a safety net, like under a trapeze artist, just in case they miss their big trick.
Okay, I like it.
Basically, a stop-loss order tells your exchange to automatically sell your asset if the price drops to a certain level, a level that you set.
So say I buy Bitcoin at $30,000 and I set a stop-loss order at, $28,000. If Bitcoin starts going down and it hits $28,000, my order just automatically sells.
Yep. You're out of the trade before things get any worse. It helps to take the emotion out of it.
Right, because when the market's going crazy, it's easy to panic.
Exactly.
Make some bad decisions.
You get those knee-jerk reactions, but the stop-loss is like your rational safeguard.
Wow, I like that. It's like my backup plan. Yeah. All right, so stop-loss orders. Definitely adding that to my crypto toolkit. What else should we be thinking about? The payset.io post mentions some more advanced stuff like hedging and derivatives. Those sound a little intimidating, honestly.
They can be, but let's break them down. Think of hedging like insurance for your investments. It's a way to offset potential losses.
Insurance, okay.
Yeah, by taking a position that will benefit if your main trade goes the wrong way.
So I'm protected if things go south. But how does that actually work? Can you give me a real-world example?
Sure. Say you're really bullish on Ethereum, you buy a bunch, hoping the price is going to go up.
Right.
But you're also a little nervous about the market. It's volatile. To hedge that bet, you could buy something called put options on Ethereum.
Put option.
A put option gives you the right, but not the obligation, to sell Ethereum at a specific price within a set time frame.
Okay, so if Ethereum crashes, I can use my put option to sell it at that higher price that I locked in. Right. Essentially limiting my losses, but if it keeps going up, I can just let the option expire and ride that profit wave.
Exactly. That's the idea with hedging. You manage the risk without completely giving up on those potential gains. It's a pretty useful strategy, especially in a volatile market like crypto.
Makes sense. All right, hedging, less scary now that you explained it. What about derivatives? That word just, I don't know, it makes my head spin a little.
Well, derivatives can seem complicated, but basically they're financial instruments that get their value from an underlying asset. So think of them like contracts betting on the future price of a cryptocurrency.
Okay.
And in the crypto world, futures contracts are a pretty popular type of derivative. It's an agreement to buy or sell a cryptocurrency at a set price on a specific date in the future.
So say I think Bitcoin's going to be $50,000 in 6 months. I could enter into one of these futures contracts to buy it at that price. If I'm right and Bitcoin goes above $50,000, I make a profit.
Yeah.
But if it's below $50,000, I'm still stuck buying it at that higher price.
That's the risk. You could lose money. But futures contracts can be used for speculation, like you just described, trying to profit from those price movements. But they can also be used for hedging. For example, if you're worried about Bitcoin's price dropping, you could sell a futures contract. If the price falls, you actually profit from the futures contract, offsetting the losses on your Bitcoin holdings.
So derivatives, powerful tools. But it sounds like you really got to know what you're doing.
Absolutely. It's super important to understand how they work before you just jump in. There's a lot to learn. You could easily make some costly mistakes
Right.
if you're not careful.
Which brings us back to the whole knowledge is power thing. The Payset.io post talked about continuous learning, always doing your research. Are there any specific resources you recommend for keeping up with this crazy fast-moving market?
It does move fast.
Yeah.
For staying on top of things, I'd start with websites like CoinGecko and CoinMarketCap.
CoinGecko, CoinMarketCap.
They're great for tracking cryptocurrency prices, market cap, trading volume, all that.
Got it. I've definitely seen those. What about news? Where do you get your crypto news?
For news and analysis, I like websites like CoinDesk and Cointelegraph.
CoinDesk and Cointelegraph.
They have really in-depth articles, market reports, expert opinions, all sorts of stuff.
Nice. For someone like me who's still kind of, learning the basics, are there any good educational platforms you'd recommend?
Oh, for sure. Online learning platforms like Coursera and Udemy have a ton of courses on cryptocurrency, trading, risk management.
Oh, right. Okay.
Yeah, you can find everything from beginner stuff to more advanced courses on specific topics like technical analysis or blockchain technology.
That's awesome. So much to learn. But even with all the knowledge in the world, I think we also need to talk about the emotional roller coaster. The ups and downs of crypto trading. How do we stay level-headed when the market's just going nuts? It really can feel like an emotional roller coaster. One minute you're riding high, the next you're, plummeting back to earth.
Yeah, the emotional side of trading can be pretty tough. I mean, you're dealing with real money, and that volatility can trigger some strong emotions.
Oh, definitely. Fear and greed, they can really cloud your judgment.
For sure.
I know I've definitely felt that fear of missing out, that FOMO. You see a coin pumping and you just jump in without thinking.
Yeah.
Like, oh, everyone's making money. I got to get in on this.
Sick.
And then there's the panic selling. The market starts dipping and you just want to get out, even if it means taking a loss.
Yeah, those are some common emotional traps.
Perhaps, yeah.
The key is to recognize those emotions. You got to acknowledge them, take a step back before you make any rash decisions.
Right.
Having a clear trading plan, sticking to your risk management strategy, that can really help you stay grounded when things get crazy.
So it's like having a plan for your emotions too, like a pre-flight checklist. Okay, am I feeling greedy? Am I feeling scared?
Yeah, exactly.
Maybe I should just walk away from the computer for a bit.
Good idea.
Any other tips for keeping a cool head when the pressure's on?
One thing that really helps is to focus on the process, not the outcome.
Okay.
It's easy to get caught up in those potential profits or losses, right? But ultimately, you can't control the market. All you can control is your own actions, your own decisions.
Right.
So if you focus on making good, well-informed trades, based on your analysis, your risk tolerance, you're much more likely to get consistent results.
So it's kind of like being a good athlete. They don't win every game, but they focus on training, strategy, consistency.
That's a great analogy.
And that's what leads to, long-term success.
Exactly. Another good tip is to find a community, Surround yourself with other traders.
Okay.
Share experiences, insights, even just vent your frustrations.
Oh, yeah, because it can be a lonely game sometimes. So having that support system is super valuable.
It is.
It's like, hey, we're all in this together.
We are.
We're learning. We're navigating this crazy world of crypto. Well, I think we've reached the summit of our crypto risk management climb.
We made it. Hopefully you've picked up some good tools along the way. I mean, we covered a lot. We talked about volatility, the different kinds of risks. We dug into diversification, position sizing, stop loss orders, even touched on hedging and derivatives.
Wow. Yeah, it's been quite the journey. And I think maybe the biggest takeaway is that you got to keep learning, always do your research, and that emotional control, so important. So as we wrap up this deep dive, I want to leave you with one last thought. Imagine you're putting together your own personal risk management checklist. What are your top 3 priorities? What are the non-negotiables you're going to stick to no matter what the market throws at you?
That's a good one to think about.
It's all about taking what we've learned today and making it your own.
Exactly.
Because, trading is a personal journey.
It is.
It's about finding what works best for you, your risk tolerance, your goals.
Last.
And remember, this is just the start. Crypto is always changing, so stay curious, keep learning, and trade smart.